welcome to The Explainer. Today, we're doing something absolutely awesome. We're running one of the most recognizable stocks on the planet, the Coca-Cola Company, through the ultimate valuation gauntlet. We're going to strip away all that market noise and force its latest financials through the rigorous frameworks of investing legends like Warren Buffett, Peter Lynch, and Benjamin Graham, plus some modern discounted cash flow models. Let's see if this blue-chip darling is actually worth your money today. All right, let's put our contestant under the microscope. Look, Coca-Cola represents way more than just a beverage, right? It's literally over a century of global consumer mindshare. But our job today isn't to just sit here and admire the branding. We need to figure out if that shiny, effervescent exterior is actually backed by cold, hard financial reality. So here is our gauntlet for today. We've got 1, the Coca-Cola snapshot, 2, the Buffett lens, 3, the Lynch lens, 4, the Graham lens, 5, modern valuation models, and finally, 6, the final verdict.
Kicking things off with part 1, the Coca-Cola snapshot.
The sheer unmatched scale of this company is just staggering. Trading under the ticker KO at around $81.27 a share, this global behemoth operates in over 200 countries and serves up 2.2 billion drinks every single day. Think about that for a second. And they aren't just pushing one soda. They command 32 individual billion-dollar brands. That's the massive foundation we're working with here.
Moving on to part 2, the Buffett lens. When we run Coca-Cola through Warren Buffett's quality checks, they pass with flying colors. They possess a practically impenetrable economic moat driven by intense brand loyalty and a global distribution network that honestly just cannot be replicated. Their earnings, incredibly consistent. Q1 2026 comparable EPS just jumped 18%. Plus, they boast a staggering 39.33% return on equity, which proves they are ridiculously efficient at compounding capital. All of this while keeping debt totally manageable with a 1.10 debt-to-equity ratio and executing really smoothly under honest, capable management led by Henrique Braun. So, high quality? Absolutely. But as you know, quality is only half of the Buffett equation, right? Price is the other. To figure out Buffett's buy price, we need to look at owner earnings, which is basically the true, unencumbered cash a business generates for its owners. Now, since specific maintenance capex isn't cleanly broken out in their reports, we're going to use their robust 3.59% free cash flow yield as a proxy. That means Coca-Cola is generating about $12.5 billion in cold, hard, distributable cash. So what would the Oracle of Omaha actually pay for those cash flows today? To get his required margin of safety, that built-in buffer against being wrong, he'd definitely want a slight discount to today's elevated multiples. Running a basic owner earnings yield calculation, that triggers a buy somewhere closer to the $70 mark rather than the current 81. It's a wonderful company, sure, but Buffett would likely hold out for a slightly more wonderful price. All right, let's shift gears to part 3. The Lynch lens. Applying Peter Lynch's famous categories, Coca-Cola is decidedly not a fast grower. Lynch would immediately peg it as a stalwart. We're talking about a massive, highly reliable cash machine. Stalwarts offer moderate, steady growth, like Coke's recent 10% organic revenue growth, and they provide vital protection during market recessions, which in this case is bolstered by a very solid 2.61% dividend yield. But this brilliantly illustrates the catch with buying a stalwart today. Lynch relies heavily on the PEG ratio, that's price to earnings divided by the growth rate. A perfect Lynch investment has a PEG of 1.0, meaning price and growth are in perfect harmony. Coca-Cola's current PEG? A lofty 3.14. You're paying a very hefty premium for that stalwart stability. Because of this high price tag for moderate growth, the strict Lynch-style verdict here is just a hold. Things are about to get a bit tougher in part 4, the Graham lens. Running through Benjamin Graham's old-school defensive investor checklist, Coca-Cola passes easily on adequate size with a massive $349 billion market cap. They also breeze through the consistent earnings and reliable $2.04 dividend checks. But then, the wheels kind of fall off. They fail the liquidity test with a current ratio of 1.36, which is below Graham's 2.0 ideal, and they violently failed valuation metrics. Graham wants a PE under 15, Coke is over 25. He wants a price to book under 1.5, Coke is sitting at a whopping 10.40. To really hammer this home, let's crunch the numbers on Graham's famous intrinsic value formula. That's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. If we plug in Coca-Cola's 2025 EPS of $3.05 and a calculated book value per share of $7.47 from their balance sheet equity, we arrive at a pretty shocking result. Graham's strict intrinsic value for Coca-Cola sits at just $22.64 a share. No way, right? Why so low? Well, because Graham's formula heavily penalizes companies that trade at massive multiples to their tangible book value. The father of value investing simply wouldn't touch this stock today. He'd demand a massive margin of safety that the current market price absolutely ignores.
Let's step into the 21st century for Part 5, Modern Valuation Models. Let's look at this sensitivity table. We built a base case discounted cash flow model using data pulled straight from Ticker, assuming a 7% weighted average cost of capital and a highly conservative 2.8% revenue growth through 2035. This model projects a fair value of $102 per share. If we trust the modern DCF methodology, which really accounts for the long-term cash generation power of the brand, this actually implies nearly a 30% upside from today's price. But hold on a second. Let's cross-reference that with an alternative model, comparable multiples. Coca-Cola's enterprise value to EBITDA multiple is sitting at nearly 23 times right now. The broader industry average, that's closer to 15 times. So this really confirms that while the DCF is super optimistic about future cash flows, the broader market is already pricing in a massive, massive premium for Coca-Cola compared to its peers. Wrapping it all up with Part 6, the final verdict. Here is your master scorecard for Coca-Cola. Benjamin Graham hates it at this price and says sell. Peter Lynch thinks it's fully priced for a stalwart and gives it a hold. Warren Buffett loves the business but probably wants a slight discount closer to $70, so he says wait. Meanwhile, modern DCF models see a clear path to $102, practically shouting, buy. So the crucial takeaway in our final synthesis is this. Coca-Cola is undeniably an elite high-quality business. I mean, they have an unrivaled brand moat, their operating margins recently expanded to an incredibly impressive 35%, and they're still growing volume globally. However, the key risk is simply the price tag. At a 25.5 PE ratio, it is priced for absolute perfection, which leaves very little room for error if commodities squeeze their margins or if currency headwinds start to strengthen. Ultimately, Coca-Cola survives our valuation gauntlet, earning a solid hold rating today. It's a phenomenal business that you likely don't want to sell if you already own it, but you might want to wait for a broader market pullback before initiating a brand new position. And it leaves us with one final provocative question for your own portfolio strategy. Is it better to buy a wonderful company like Coca-Cola at a merely fair price today, or wait around hoping for a wonderful price that may never actually come? Thanks for joining me on this explainer, and happy analyzing.